In this video, we're going to talk about Senseonics, trading under the ticker symbol SENS. There's a lot of volatilities coming out of the financial market and especially from the growth stock. And we have to be careful about which stocks to buy, which stocks to sell, and which ones to keep an eye on. In this video, we will cover the recent price action momentums and the technicals of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed and that it may not take into consideration the latest developments. If that is the case, I will make follow-up videos to reflect those events. With that being said, let's begin with today's topic. During the most recent trading session, the stock decreased to $1.62 before closing the trading day just above $1.60. We gotta pay attention to the $1.40 level nearby because it was tested 3 times before, which is a significant level to watch out for. Over the past 30 days, the trend of the stock has been bearish, as the stock has now declined very quickly over a short period of time and is now testing the support level of $1.40. It's worth mentioning that below that price level, we are truly exposed to a downtrend all the way back to the penny stock territories, and there may be a long way to go from there. From the perspective of a longer time frame though, 6 months and above, the trend of the stock has been trending within a range, and because the cycle has been fairly long, for the moment, despite the short-term selling pressure, I believe that as long as we can find a good support somewhere down in the penny stock levels, it's still too early to say that the stock isn't necessarily a downtrend per se. It's going to be a hard few months ahead of us, but at the same time, there may be some light at the end of the tunnel if the entry point is sufficiently low. When we look at the price trend overall, it has been accelerating downward because the stock was simply testing the support levels and trending mildly into bullish territories for months, and the dip was very recent and sudden. The trading volume of Senseonics has recently been 13 million shares compared to the average volume of 22 million shares. Over the previous 52-week period, its price fluctuated between $1.60 and $4.58. The market cap of Senseonics is currently at $713 million versus the enterprise value of $1.9 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap, which is refreshed every single day, and more lenient, often, for many companies. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they have is called goodwill. Goodwill is an expectation of the market that this company can generate more profit or to have more growth than its rivals, partially because it may have a good management team, a stronger brand recognition, or a bigger online following. It is basically what is unique about this company in particular versus an alternative competitor. In other words, it's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, and because the market cap is also more reactive to the enterprise value. The company goes to liquidation, the goodwill would be gone, and we would be left with potentially less assets to distribute amongst shareholders and bondholders. When we compare the current price to historical price fluctuations, the stock is 1% higher, or making new lows, than its 1-month low, 3-month low, and 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to head toward, the implied volatility here is 125% versus a historical volatility of 151%. The put-call volume ratio is currently at 0.53. It's normal for many stocks to tend to have a higher put option volume than what they truly deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 17,000 contracts in a day, versus the 30-day average of 23,000. Regarding the open interest, the most recent volume of open interest has been 393,000 contracts versus a 30-day average of 363,000 contracts. In terms of its shareholder structure, institutional shareholders own 30% of its outstanding float. The biggest shareholders include BlackRock, Vanguard, and State Street. It's relevant to understand the shareholder composition of a company because it helps to determine whether you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, then this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions since many great titles are also held by retail traders and not institutional ones, but so far this is the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total float, it can be a sign that there's an organized shorting operation going on. The current short interest is 25% of the total float and 30% coming from the dark pool. So there can be an argument made regarding the fact that there is an organized shorting operation going on with the stock. Overall, my opinion on Senseonics is to keep the company on your watch list because the company has a lot of potentials on a fundamental level. With that being said, the stock is currently in a clear downward trend, and it can take a while before the stock finds more support. We have to watch closely the $1.40 level, because if the stock maintains itself above that price level for 1 or 2 weeks, then this can be a sign that the stock will decide to reverse from there onward. If it doesn't manage to hold the line there, we would be looking at the penny stock levels. The maximum exposure I would recommend is 1% of your portfolio for the time being. For the immediate term, my recommendation is to wait for better timing, because we have to see some confirmations that the support levels can be reached or be able to hold at least for the medium term. I would recommend to separate the allocation in batches of 10% at a time so that you can have enough room to purchase later. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.